Investors are rushing to gold in search of safety, but how high can it go? This is Sectors Up Close, and we're talking gold. The precious metal hit a new all-time high on Monday morning of $4,689 an ounce after President Trump issued new threats of tariffs to European countries over Greenland at the weekend. Gold gained 64% in 2025. So can its massive run-up ever run out of steam? Joy Yang is head of product management at MarketVector Indexes. Joy, after gold gained so much in the last year, does it still count as a safe haven choice? Doesn't this start to look speculative?
Investors, rightly so, are questioning, with this type of astronomical rally, can it keep on going up? So, absolutely nothing goes up forever. You have to consider the risk, and gold is becoming very, very risky when we're looking at the volatility around the price, and it's even becoming more risky than stocks. But I think one thing investors have to keep in mind, that you don't find the fair value of gold prices the way you do with stock and company prices, because you can't value it through cash flow or earnings. So it's really about the supply and demand, and you can't look at history to understand what's the price going forward. So I can say it can keep going up, but as with all momentum rallies, we do expect pullbacks, because this rally is attracting momentum chasers. And as we've seen with Bitcoin, when these momentum chasers come into the market, they can also quickly go out of the market.
Does that mean there are risks here that gold buyers might not be taking into account?
There are definitely risks, but for people who want to invest in gold as a long-term value play, they have to think about the demand and supply. And we know at the end of the day, gold has limited supply. It takes time to extract. And, there's just so much of gold that we have. And on the demand side, you have to think about what are the structural drivers versus what are maybe short-term flows. And we saw the rally in gold prices really come on when we saw central bank come on board, and they have been consistently buying ever since the Ukraine war. So we believe that's a structural floor for gold, and they will continue to buy as long as they want to de-link themselves from the dollar. And I think now more than ever, as we've seen just at the beginning of January, there's a lot of questions outside of the U.S. on dollar dependency as well as dollar asset risks. So we see that as a structural buy. We see ETF buyers, retail buyers come back into the market. But again, those may be short-term fads as they find other shiny new price momentum rallies to chase after gold kind of tapers off.
How much, though, do you think this is about international investors getting increasingly more nervous about US assets that were previously seen as safe havens, whether it's US treasuries or the dollar?
I think, yes, definitely when you take yourself outside of the US, there's increasing concerns about investors' exposure to US dollar, to US assets, to large cap US assets, which are becoming more and more concentrated, to the extent a lot of these headlines are driving global fracture around the world. There's a lot of better opportunities out there. Gold is one of them for hedging your uncertain outcomes, as well as international plays, whether it's emerging markets, developed markets. When you look at the relative valuation, there's a lot more attractive opportunities to even capture the AI story without taking on the US dollar risk.
You mentioned investors saying that gold is still broadly underallocated. Do you agree with them?
Yeah, so if you look at the total gold market out there, and you look at how much investors are allocating to gold, it's probably closer to 1% to 2%, when people are recommending up to 10% in gold. And I think we're seeing flows into gold, but that doesn't necessarily mean that you don't see market opportunities elsewhere. So just like you can buy property insurance, it's not because you want your house to burn down, but because it's the prudent thing to do. And we're seeing gold, because it has different drivers from stock market, it should go up and down differently from the market. So it seems to be prudent, certainly as an insurance opportunity, to hold gold, even if you don't know what the growth opportunity in gold is.
You mentioned how difficult and expensive it can be to extract. Are gold miners seeing much upside here? Does it make sense at this price to invest in mining companies?
Yes, so we're also seeing an explosive gold miner growth, not just in 2025. When gold was up 60, gold miners were up 170. So gold miners, because they have fixed operating costs, are really an operating leverage to the price of gold. So even year to date, gold miners are up, I think, 12, 15% when gold is up 6, 7%. So we're seeing this kind of play, which is natural given their linkage to gold prices. But again, what goes up can also go down. When we talk about the leverage opportunity, it can fall twice as much as gold also.
That was Joy Yang of MarketVector Indexes. Don't forget you can watch more videos on Reuters.com.